Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Strategas founding partner and chief economist, Don Rissmiller. Don, how are you doing today?
Very good, Ross. Good to talk with you.
Yeah, good to talk to you as well. I want to get your sense of the recent economic data to the extent that there has been some. You wrote a note titled "The Soft Patch is Coming to an End," and I wanted to get your sense on what contributed to the soft patch that we've seen in the fourth quarter, and then what signs you're seeing that things are starting to pick up into year end, and then set the stage for a better 2026.
Yeah, it's an important question, Ross. And so I'd say the idea that the soft patch is ending doesn't mean that we won't print any negative numbers, because some of those numbers are still going to be backward looking. We saw this, for instance, today with the ADP employment release for November. For a November data point, we had a negative number because that was the middle of the soft patch. The idea here is that the market has had some time to react to layoff announcements, to react to some of the weakness that we've seen. And now looking forward, it's going to start to price in 2026. So the 4Q soft patch was legitimate, it was real. But what we think the market's going to look at is what's coming next. And as long as earnings are still good and capital spending is still positive, we have a bridge to getting the economy to broaden. And I think that broadening is what policy is aiming at. So fiscal policy, monetary policy with rate cuts, deregulation, all of that as we go into next year is aimed at getting a broader growth profile. And we think that's going to work.
Yeah, and I want to get to the policy piece in a minute, particularly about the Fed and expectations for rate cuts. But I do want to hone in on the labor market a little bit more and the consumer spending picture and just ask how you reconcile the narrative and the headlines that we're seeing about layoffs, particularly at some of these bigger companies that they've made headlines with big layoffs, and the fact that initial claims for unemployment insurance, which is typically how we think about firings in the economy, have remained really, really low. So how do you think about that dichotomy, and how does that set the stage for consumer spending as we head into next year?
Yeah, we've had a very odd labor market where there's been limited firing but limited hiring as well. So we've started to see some pickup in layoff announcements. Some of that was tied to government and the government shutdown and some of the buyout programs. Those will roll through the numbers as time goes by. But there, as you said, been some legitimate pickup in some of the private sector numbers as well. What we're looking at is what's a cushion. And what we focused on for quite a while now is how flexible the labor market has become, especially for jobs that are in the gig economy. So this might be an Uber or Instacart or DoorDash or social media or those type of businesses where someone could work one week and not work the next week, could work half a week, could work one day a week if they really wanted to. It's a hyper flexible form of employment. And these may not be the best jobs. You don't get a pension, or you don't get a 401k, or you don't get health insurance, but you do get income. And it's a readily available form of income. There's not a lot of qualifications. If you have a phone and a car, you can probably try to participate in this part of the economy. So there's been a cushion, especially for a lower income consumer, where you can access income at your discretion. And I think that has helped. That's helped mitigate some of these other labor market concerns that we've had now over the last several months.
Yeah, and certainly to the extent that it showed up in Black Friday numbers and Cyber Monday numbers, seemed like a pretty positive holiday weekend altogether. So now I do want to shift to the Fed, and we know that the Fed is likely to cut next week. There's still an easing impulse at the central bank, but I want to put your forecaster hat on and look out towards the middle of 2026 and say, the Fed has cut a couple more times. As we're looking towards the end of next year and maybe even to 2027, with the inflation picture somewhat sticky, with the labor market fairly tight, at least in terms of labor supply, are we going to be thinking about further rate cuts or even potentially about hikes as we look to 2027?
Right. So right now, as you said, we're talking about rate cuts. We're talking about rate cuts in December, maybe the first half of next year. If we get to the middle of next year we have a Fed funds rate that's probably in the neighborhood of a neutral rate, where it is neither stimulating the economy nor hurting it very much. I think when you get to that point, the optimal policy is going to be to pause. I don't think we're going to have rate cut after rate cut after rate cut as we move through next year. The goal here is not to get to stimulative. The goal here is to get to neutral. The stimulus is going to come from fiscal policy and perhaps regulatory policy. So monetary policy doesn't need to do the heavy lifting next year. Maybe there will come a point where we have to start talking about a rate hike, but I don't think that's 2026, maybe in 2027, but we may be getting ahead of ourselves there. Let's get the cuts we are expecting now. Let's get to neutral. Let's pause at neutral. That I think will get us through the bulk of next year.
Right. And as you mentioned, a lot of fiscal stimulus coming down the pipe as well, with some of those consumer and business tax cuts in the one big beautiful bill that should hit pretty aggressively in 2026 and 2027 in particular. Well, Don, this has been incredibly insightful as always. I want to thank you so much for the time, and we will look forward to talking to you again soon.
Very good to talk with you, Ross.